Gamma Limited is a manufacturer of trucks. In year one, Gamma has an aggregated turnover of $80 million, assets of $150 million, and financial assets of $10 million. The company enters into a 5-year loan with a bank to borrow $9 million, with interest of 6% payable annually in arrears, and with a final repayment of $10 million at maturity. Gamma does not meet the threshold requirements of the TOFA regime and has not elected to apply TOFA. However, the arrangement is considered a qualifying security, and so the TOFA regime will apply to Gamma's loan, and it may be able to deduct a loss on an accruals basis over the life of the financial arrangement. In year 3, Gamma has an aggregated turnover of $110 million, and the TOFA regime now applies to Gamma on a mandatory basis. Gamma enters into a contract to sell a truck valued at $420,000 to Ray Limited on 1 July in year 3. Under the contract, Gamma must deliver a truck to Ray on 1 October in year 3, and Ray must make a payment of $500,000 on 30 June in year 5. On 1 October in year 3, the market value of the truck was actually $400,000. As at the contract date on 1 July in year 3, there is no financial arrangement in place. Gamma has a non-cash settlable obligation, that is, the obligation to provide the truck, which was not insignificant in comparison to the cash settlable right, that is, the right to receive $500,000. However, Gamma starts to have a financial arrangement from 1 October in year 3. This is because a financial arrangement arises where there is no longer a non-cash settlable, non-insignificant obligation. That is, when the obligation to provide the truck is satisfied. Gamma makes a sufficiently certain gain of $100,000 under the financial arrangement, representing the difference between the receipt of a financial benefit of $500,000 and the provision of a financial benefit of $400,000, being the market value of the truck on the date of delivery, not the date of contract. Gamma may be able to spread the gain over the term of the arrangement, being from 1 October in year 3 to 30 June in year 5. The taxation of financial arrangements regime is designed to align the taxation of gains and losses on financial arrangements with the relevant commercial outcomes of those arrangements. It seeks to reduce opportunities for tax deferral and tax arbitrage by better matching the timing of taxation and the classification of taxable gains and losses. TOFA therefore looks at the economic substance of financial arrangements rather than their legal form. Certain entities are subject to TOFA on a mandatory basis, and certain financial arrangements are subject to TOFA regardless of entity. Generally, TOFA applies on a mandatory basis to entities, except individuals, that have aggregated turnover of at least $100 million, or assets of at least $300 million, or financial assets of at least $100 million. However, TOFA also applies to financial arrangements for other entities that extend beyond 12 months or that are deemed qualifying securities. A financial arrangement exists where there is a cash settlable right to receive a financial benefit or obligation to provide a financial benefit, such as a contract to pay $100,000 to a supplier. However, a financial arrangement does not exist where the entity also has a not insignificant right or obligation to provide or receive a non-financial item under the same arrangement, such as receiving delivery of purchased goods at the same time and for the same value as the cash payment to a supplier. Examples of financial arrangements include discounted securities, deferred payment purchase agreements, equity interests, and foreign currency. Exceptions include short-term trade credit, leasing arrangements, and superannuation benefits. Once a financial arrangement has been identified, the net gain or loss from the financial arrangement needs to be determined. This is based on offsetting costs against proceeds from the financial arrangement, with the resulting gain or loss generally being included in assessable income or allowed as a deduction on revenue account. However, the timing of recognition of the gain or loss for tax purposes is dependent on the tax time methods. There are 2 default tax timing methods and 4 elective tax timing methods. When none of the elective methods apply, then the default methods apply. Where more than one method can apply, the priority rules confirm the appropriate method. Further, once the financial arrangement ceases, a balancing adjustment may be required. Broadly, this balancing adjustment brings to account any difference between the financial benefits received, including any tax deductions, and the financial benefits provided, including any assessable income, as either a gain or loss from the financial arrangement. To recap, the TOFA regime seeks to align the tax character and timing of gains and losses on financial arrangements with the underlying commercial outcomes of those arrangements. To be captured, the arrangement needs to be a financial arrangement relating to an eligible entity, and the taxable gain or loss needs to be brought to account in accordance with the available tax timing methods.